Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce and Associates Wealth Consulting, and welcome to Charts and Chat for January 11th of 2026. Well, welcome everybody to the second Charts and Chat of 2026. It's a lot going on in our world right now. Obviously, we have the Venezuelan issue that's still out there with regard to how that's going to play out, and we've got some slides on that. Also have obviously Ukraine, we have Greenland, we have protests in Iran, and there's just a lot of things going on. And so I thought it was helpful with that context to kind of go back and look at some of the issues that we face geopolitically, over, call it the last 50 to 75 years. And really the analysis here in this table, you can see it's really a mixed bag. So, there's no conclusive data that says that these geopolitical issues have a lasting effect on the market. In some cases, in 2001, the war in Afghanistan, the market was already in a financial turbulent period. We were already dealing with kind of a mild recession around that time. So, you can't really say that the war in Afghanistan led to, after 12 months, led to a significant downturn, because that was predicated on other things. Not to say that geopolitics doesn't have an impact. I'm just saying that it's just very inconclusive that it has a strong and lasting impact on the investment markets. So as I promised, we'll talk about Venezuela. Obviously, the agreements that look like they're being forged with U.S. oil companies to perhaps engage in production, although we heard a lot of rhetoric this past week, particularly from, say, for example, ExxonMobil. It's been down there twice and have had assets expropriated twice. So, it's definitely a risk environment, and I think it's going to take a lot of incentive and a lot of guarantees and security commitments to get U.S. investment to help build up this production in Venezuela. And you can see here, going back to 1994, we had the Chavez regime in here, and then we had Maduro, which took over and was, even less of an effective leader. And you can see here production has gone down, and this is not to be extrapolate that they're on a significant upturn. It just happens that, we're probably close to around, call it 800,000, 900,000 barrels a day for a country of Venezuela's resources, which we'll talk about in a second, is very significant. You look at oil rigs that are operating in Venezuela, you can see how that's gone down to basically just a mere trickle. I mean, we've got 2 oil rigs and primarily the Orinco belt, which is the primary field that's in operation in Venezuela now. So again, not much going on in Venezuela. There is a lot of opportunity, but again, I think there was some hope for regime change and something that has more of a democracy influencing aspect to it that hasn't really played out. Right now, it just seems a lot about oil, and again, we'll have to see where that goes. Proven oil reserves, no question. You've got Venezuela about 19-20% of the proven oil reserves in the world, even ahead of Saudi Arabia. Iran, which we just kind of alluded to at the front end, is undergoing a series of pretty widespread protests. And the regime there is taking a fairly hard line to that, so we'll have to see where that goes. But this is probably as strong a rebuke of the Iranian administration that we've seen in a very long time. And then you've got the U.S. down here. Although, from a technology standpoint, these are proven reserves. There's unproven reserves. Obviously, there's the Arctic that we can talk about. And that there are other things, other areas that we can talk about where maybe they're not proven. But this is just what we do know at this point just from geology. So we've been talking about these oil reserves for Venezuela. You can see that this is where we are now, about 300 billion barrels. And of course, we've come a long way at the same time that production has really gone down hill here. So We really haven't done any new geology on this in this whole area. So this number could be quite a bit higher. We just don't know. We just haven't applied any science to the region in a very long time. We will shift gears now and talk about the domestic economy. Have quite a few charts this week on that. Here you see the number of business applications, all-time high levels. This is very good to see. This is amidst whatever you may feel in terms of where the economy is going or where it is right now. Obviously, there's a lot of differences of opinion on that depending on your household income level. But this is definitely trending in the right direction. And again, multi-year trend here with some noise disruption around that pandemic period, but the glide path here is certainly up, and so this is a very good sign. We have bank loans. You can see that those are trending higher. We've been monitoring the senior loan officer surveys that are still, erring on the tighter side of credit, meaning that credit is not as easy to get as it was or has been in the past. But despite that, you see bank loans both in the euro area. This is important, as well as the United States, both moving higher. So when we think about that kind of this coordinated global expansion, and you have more regions participating in overall growth. It's obviously positive from an investment standpoint to have kind of a synchronized global recovery of sorts, or expansion, at least we'll call it. But you can see here clearly expansion capital being lent out in some very key areas of the global equation. Institutional loan activity, here we have data. Uh, Again, this is through almost the end of the year, but had a bit of a dip in 2025. Most of that was kind of a decline in kind of repricing activity, but when you look at non-refi issuance, that's pretty steady. Refi is a little bit lower. Obviously we had different interest rate environment a year ago, so that had some influence on it as well. But when you look at it in the aggregate relative to the historical backdrop, with the exception of 2017, the overall level of institutional loan activity is actually very strong. Now we look at the other side of the coin. We look at defaults once those loans are made. Something that we have been monitoring for a number of years, and you can see here 2022, 2023, that default rate on corporate bonds had gone up, and we expected it to. You've got monthly bankruptcy filings that are plotted against this, which, as you would expect, correlate pretty well. But oddly enough, we've seen some divergence here. You've seen monthly bankruptcy filings that have honestly remained somewhat steady. I mean, we haven't, this near-term trend, if you go back, call it 3 years now, there's really no discernible trend here other than it's kind of range bound after having picked up for a number of years prior to that. But you can see here, default rates have picked up, and I've seen other data where this maybe is a little bit steadier than what might be indicated here. So again, we'll watch this. Divergence is a little curious here that you see, because that historically has not been the case. But again, we'll watch the data. We have U.S. recession probabilities, which continue to go down. So this data series goes back to the beginning of October, when the consensus out there was somewhere closer to 35-40%. That has definitely gone down, looking around 25% probability of a recession, which seems kind of like odd on its face, because you really don't ever hear about this being talked about in the mainstream financial press right now. Now we'll spend some time talking about the housing industry, and I have probably from Apollo at least another 15 to 20 charts that I didn't even include this week, but hopefully this will provide kind of the basic synopsis of what's going on. We do know that affordability is an issue. So when you look at home builders and also current conditions for buyers, In the green line, you can see that that's obviously lower because you have kind of stubborn 30-year fixed mortgage rates. We'll look at that in a second. But and then you have high prices that, maybe if they're not growing as fast, they're still growing. That doesn't mean that they're in abject decline, but they are moving higher. So you see affordability translating into, at least from a sentiment standpoint, weaker conditions for buying houses for consumers, and then also for builders that honestly on new builds right now, a lot of builders are struggling with that. And it's not just the input costs, but it's also the aggregate demand because of that affordability. And I should say it does have a lot to do with cost, but at least not from the standpoint of supply chain choke points like we had several years ago. But it's been a very difficult environment, and a lot of builders are having to give up points and incentives to get people to buy homes. Housing affordability index we just looked at, you can see that that's still relatively weak, and you go back in this time series, you almost have to go back to the early 80s before you find an aggregate level of this index that's as low as what we've seen here lately, and obviously 2007 gets very, very close to that. So applications for refinancing of mortgages, you can see here a little bit of an uptick. This is a very long data series going back to 1991, but really over the last couple of years, you see a little bit of an uptick after that really just kind of dropped out of the bottom. So maybe a little bit positive. I'd say that mortgage rates have remained fairly sticky, but around 6.1, 6.2, you're seeing a little bit of flushing out here. Mortgage rates themselves, as we see here, getting close to 6, and peaking out kind of almost at 8 at one point, and then kind of saddling in the 6s to near 7 for a period of time. So a little bit stubborn. Maybe the last few data readings are kind of like sliding because we're seeing a little bit of relief in the 10-year Treasury around 4.1, 4.2, but those mortgage rates are still pretty high. And this line is always very interesting to me because it shows you the effective interest rate on outstanding mortgages now. And you think that, at one point there was like 60, 70% of mortgage holders. And again, remember, there are 40% of homes that do not have a mortgage, but the other 60% who do. The average interest rate continues to move up because overall mortgage rates are higher. But the trough here was in 2022 when the effective interest rate was well below 4%. And you can see now that it's maybe a little bit higher than that. This chart, we have really one of the best representations of the affordability problem right now. When you think about, average hourly earnings, you think about wages, and particularly real wages adjusted for inflation, you can see here that we've seen the average monthly mortgage payment on a 30-year mortgage jump considerably. And you think about just from an average aggregate level, I mean, we were like 1,700, and now at one point it was close to 3,000, and still about 2,700. That's significantly higher and much greater than the rate of inflation. So we feel purchasing power impacted here, particularly on the part of lower income cohorts, where this change right here, this delta from this level to this level is extremely meaningful, and is a big reason why we see in these sentiment indicators this kind of K-shaped philosophy where the lower income cohorts are really feeling the pain, whereas upper income cohorts are not necessarily feeling as bad. Delinquencies as a percent of total mortgages, I would say that this is fairly steady and unremarkable in terms of its signaling here. There's nothing that says we're on the cusp of a major credit problem with regard to the mortgage industry, which is obviously something that we have not been able to say during previous challenges in our economic framework. Household formation, this is very interesting. So it ties directly back to affordability, and I'll continue to look for a chart that kind of gives both in one representation. But affordability has gone down, so household formation has gone down. You can see this manifest itself in a couple of charts I didn't show, which is like the median age of new home buyers is gone up considerably. In fact, that number is close to 40 years of age now, which is just tremendous when you think about it. So, young people are not buying homes, and you can see that household formation number really slide. And this is something I was talking about earlier with the average interest rate on a mortgage. This is a distribution of interest rates on outstanding mortgages. And again, there were the majority not too long ago of mortgage debt outstanding was priced at below 4%. You can see here, here's below 3, here's 3 to 4, and then here's, the higher interest rate levels. And you can see, one, not too surprising, over these last several years, call it 5 years, you've seen that, average the concentration of mortgage rates below 3% has gone down. Not by a precipitous amount, but it continues to slide just as we see 3 to 4% and 4 to 5, oddly enough. But where you're starting to see that growth again is where you'd expect it, and that's 5 or greater, because that's where the prevailing mortgage rates have been for quite some time. And now we're beginning, over time, you're going to see that this is going to be a lot more flat unless we have some type of major economic downturn in which interest rates would then go back down again. Apartment list, rent prices here continue to slide. This is actually evidence of negative growth, which is pretty profound. We had a lot of multifamily build out, and because frankly money was cheap, developers were aggressive, and the political backdrops for a lot of the larger jurisdictions were very favorable to multifamily build out, particularly because of the affordability issue with single families. So rent prices, we got saturated, and rent prices have been coming down a little bit, although they still remain relatively high. We're just at a negative rate of growth right now. So here we have a little bit of data on the job market. We talked about new business formations being higher. We talked about bankruptcies, maybe ticking up a little bit amidst that. So a little bit of conflicting data there. But when you think about small businesses, they're the ones that are fighting to grow and fighting for that access to capital, so on and so forth. But here we have, if you look at all the noise in the data. Again, this is from the Bureau of Labor Statistics, and we did go through a government shutdown, so there's a little bit of disruption there. But where we have lost significant jobs, we really haven't had a whole lot of periods where we've had a chance to offset that. So when you go back to call it April and a tariff tantrum, we really haven't to the point of this slide haven't added really any jobs. And you can see job creation was a lot more robust in the years prior than what we've seen here over the last, call it 9 months. Challenger job cuts, this goes hand in hand with what I was just talking about. You see, the 2025 band here is much higher than the average bands that we've seen over all of these different years. And this is, probably mind blowing to kind of follow all these colors, but they tell the same story. I mean, they're all within a tolerance band here, but then you've got, essentially you've got, your bad year, which was 2009, excuse me, and then you have your pandemic year in 2020. But 25 represents a relatively an oddly weak year in the labor markets, even though it didn't really feel like the labor market was dropping out through the floor. We just had companies that weren't hiring for a while, but they weren't necessarily firing. And then they, again, they started picking that up and announcing, particularly Challenger represents larger companies. And so you had larger companies announce fairly significant layoff chunks, which obviously helped to contribute to this. And then continuing claims, you think about the duration of unemployment. Honestly, we had a little bit of noise here where it did pick up during the middle of the year. and it's gone back down. And the last reading was up, but again, this is kind of almost range bound if you kind of discount the little bit of a kind of an uptick here. But continuing claims are, I wouldn't argue that they're coming down. So again, a little bit of stress in the labor market right now. Probability of losing a job. These are sentiment indicators. So you can say that that's certainly gone up. It's what 15% change here, and then probability of finding a job in a similar vein. That's gone down. So fears are going down. Or excuse me, fears are going up, I should say, in both of these cases. Now, where are we seeing the least amount of opportunity? Well, obviously, government. We went through that whole Doge thing, and government is not hiring. In fact, we've had net negative growth in government employment. You see education, trade, information. Really the only couple of places that we've seen some real traction, positive, is here in professional business services and construction. And so when you see negative prints like this on job openings, particularly for the people that work in these sectors, it helps to exacerbate these trends here. We'll talk about inflation expectations. This is the New York Fed, and pretty well anchored, and they have been for quite some time. So we've seen this kind of eke up just a little bit. So again, the Fed does this, and they ask several questions. So they say, what do you feel inflation is going to be after 1 year? Survey came back 3.4, so a little bit elevated actually. And then the 3 and the 5 year, that's looking more like 3%. So that doesn't, to me, sound a lot like the 2% that the Fed is targeting. And honestly, I just don't think we're going to get there. I think there are certainly some negative impulses on inflation that probably won't manifest until the second half of the year. But then obviously at that point you start to anniversary some of the tariff announcements. And so, once you anniversary the price level change on a tariff, after that, it's really a non-impact. Unit labor costs we talked a little bit about. They're still positive, but they have come down. Last couple of quarters, we've seen a downtick in labor costs. I think this is positive for inflation. So think about how labor fits into this picture. It actually does have a meaningful impact. And so not that I think it'll be enough to get us down to 2%, but it certainly will help to, I think, fulfill at least the baseline here of what's coming out of these expectation surveys. Now we have the balance of trade. We've had actually some very interesting trade data as of late. You can see, here's the balance of trade. So, U.S. Has a deficit in trade with other countries. We've known that, right? So we know that trade is probably worth anywhere between 10 and 15% of the total economy. And you can see exports going up. At the same time, you've seen imports really kind of trend down. And this is the period is when folks were, trying to get ahead of the tariffs, and they were, basically importing into inventory to try to get ahead of that. But imports have gone down. Oddly enough, exports with the huge print that we had last reading, which was October, a lot of it actually had to do with gold. So this is non-monetary gold exports, and you can see how this number really spiked. So a big part of this red chunk here is oddly enough tied to gold. We talk about the Atlanta Fed a lot, and this is their latest representation of fourth quarter growth. They're actually looking for something closer to 4.5 to 5%, which is some of the strongest growth we've had in quite a while. And if it does play out, and these guys are actually pretty good predictors of that. Well, where is that bump coming from? Well, okay, well, we can certainly, talk about this green area and imports. And we just got through looking at trade. And so, with the decline in imports and the increase in exports, whether or not it's sustainable, because as I mentioned, a lot of the most recent increase was due to gold exports. Um, but the trade is expected to be a net tailwind, not a headwind to economic growth. And so you get that working for you. Really, you've got all cylinders firing here. So you've got trade, you've got consumption, you have investment, which can be government, it could be state, local, it could be private investment, and you think about all the drivers of what builds into GDP. You have very consistent performance on these top, but you have that positive trade influence there. And again, just to remind you all that this is likely going to be more of a quarter phenomenon, because usually when you get trade can be quite volatile, and it was a big reason why we had a negative economic growth in the first quarter of last year, and that could certainly turn in the second quarter. Here we have fiscal boosts. Uh, this is a slide from Apollo that shows that, again, to this whole notion of having some synchronization in the expansion across the globe. I think that's represented here. So we'll let Germany serve as a proxy for Europe. It's very important, certainly from a manufacturing and as a net exporter of capital goods. Germany is looking to get an additional 1% economic growth benefit from some of the various fiscal impulses there. Japan, about half as much, but still positive in the U.S., primarily by virtue of the One Big Beautiful Bill Act, is looking about 0.9% of boost from those fiscal initiatives. Now we'll talk about some of the economic indicators. This is what I'll call the hard data here. So particularly on new orders. I mean, you see new orders here on services going up. Overall services PMI, which is the Institute for Supply Management Purchasing Managers Index. So again, this is services, still looking good and trending higher. Switching gears, we're going to look at that same ISM number, but in the manufacturing side, and you can still see the sluggishness there. It's net negatives. Everything below 50 represents a contraction, and it was a little bit less than the estimate here. And you can see new orders as well as employment sentiment still looking pretty sloppy, and this has been this way for a while. And again, I'd argue that while the world and certainly the U.S. did not go through an official recession in 22-23, I would certainly argue that manufacturing did go through a recession, and I think in many respects is still in it. Factory orders are negative here. You can see this is monthly data, so it was down 0.2%. And importantly, it was down a lot more at the headline number, but when we back out transportation, we think about Boeing and airplanes, which can be very lumpy. When you back that volatile component out, it was still negative, but not that much. But again, it was still negative. And again, if you look at monthly data, you've got to go back into kind of like I'll call it the anniversary of the reemergence from the post-pandemic economy, which we were still riding on this bit of a sugar high. And then ever since then, it's been a little bit sluggish. On this slide, we have real business fixed investment. That has been positive for some time. We did have a little bit of a head fake a little bit earlier this year. That was the tariff tantrum, and a symptom of, I would call it positive sentiment with regard to capital spending, and we certainly need that. And we know that there's a large amount of infrastructure spending that has to take place, and not just in data centers for the hyperscalers. I mean, there's a lot of infrastructure development that needs to happen, and this is also a measure of, to some degree, of executive confidence, company executives and their confidence level with regard to the economy. So I talk a lot about the soft indicators and the hard indicators, and this is a good representation of that, and how those are extremely important, but they're also very different. Look at hard data. These are, capital goods orders. These are shipments. These are this is data that we can observe in the actual economy, and that continues to move higher at the same time that the soft data, which again, to remind you, are surveys, they're sentiment, they're feelings, they're not hard data, like as the name would suggest. Those continue to sag, and we see this a lot, right? And this has been ongoing for quite a number of months now. And you can see the growth, what the implied growth is by these various categories. You see, like the soft data would, seem to suggest a contraction, which may or may not lead to some kind of recession. But that's what the soft data suggests. Whereas the hard data, and this is where a lot of people are hanging their hat on right now. It's like there are some parts of the equity market that are literally priced for perfection here, and that because people feel like it's supported by the hard data that you're going to have a good economic backdrop, and that's going to lead to higher earnings and higher stock prices, so on and so forth. Crude oil, as we know, continues to go down. Oddly enough, we did not see really any kind of a near-term spike, if you will, with the Venezuelan, military operation, as we'll call it. And again, that goes to my early point about, geopolitics. Usually when there's a threat in the world and there's a fear in the world, where you're going to see that fear kind of priced in is here in crude oil. And you frankly don't see it. In fact, there is a lot of argument when you get down here, at $50 a barrel, what the economic incentive is to do a lot of exploration drilling. And frankly, the economic incentive to go down to Venezuela and spend, a lot of your seed corn trying to redevelop those fields and whatnot. So, this is going to be very interesting to watch, because I do feel like stocks in the U.S. are very low and right now in oil, and we haven't replenished the strategic reserve. There's a lot of things going on that I think would probably lend itself to support oil prices to go up. But then again, you've got the Iranian situation, and that's $3+ million a barrel. Excuse me, 3+ million barrels a day of oil that is in play here with regard to the protests, et cetera, et cetera. Now we'll kind of broaden the conversation, and I've been spending a little bit more time on commodities lately, and we've seen kind of a bifurcation. There's certain commodities that have done really well, some that have done actually rather poorly. But when you think about it as a basket, and you think about it as a diversification tool, this is good to look at this. So you've got basically commodities versus equities here, and you can see that for a long time you could see that commodities were greatly underperforming relative to equities. And then you could see, like in 22, when the stock market really had a difficult stretch, that commodities outperformed and regained some of that deficit. And since then, interestingly enough, it's been relatively flat, to be honest with you. And we really haven't seen anything with regard to, the commodities maybe outperforming equities by a greater amount, or at least reducing that deficit. And then similarly, on the fixed income side, it went down for a while, and then we had basically a kind of a change here, as we talked about. You've got fixed income where we had interest rates moving higher, and that was being priced into the bond market, and you could see commodities really beginning to outperform. And what's interesting about this is, whereas commodities versus equities have kind of flatlined, but commodities versus bonds have really improved. And this comes at a good time because, over the last 5 to 7 years, we've actually seen probably a lot more volatility. I'd say certainly over the last 3 to 5 years, more volatility in the fixed income markets than in the equity markets. And if we're seeing an outperformance buy commodities relative to bonds, that means our diversification tools work a little bit better. So now we'll shift our attention to the equity markets. We've got consensus earnings growth for the S&P 500. That's moving higher. Again, I wouldn't have told you a year ago that I would have thought that we'd be in double digits for earnings, but we were there, and for the most part in 2025. And there are lofty expectations heading into 26, and I think it's important to kind of like take stock of and maybe feel good about, but also be eyes wide open because that number could change. And then if we look at S&P 500, we kind of break it out into into its like epics, as I like to say it, because today's S&P 500 is a lot different from your father's S&P 500. Back then, there were a lot more industrial stocks, more cash flow orientation. Here, you've got a lot more growth, and you can see that very clearly, kind of in these phases, or I'll call them epics. Here, you've got this is net profit margin. So you have you're in 1991, you had 4%, but the average there from the average at this point was like 5.1% margin. Then slowly over time that became 9.2, and we're at 12.5% right now. And you can see the impulse of the gradual shift in the index towards technology. So we'll talk about different aspects of the market. We touched on this last week. So cyclical versus defensive. So this is kind of like the infrastructure play, if you will. So like we're on a cyclical upturn because of the capital reinvestment story. And it's not just data centers, which is important, very important, but it's not the whole picture. But you can see cyclicals outperforming defensives. And then, as we talked about a little bit last week, we've got growth versus value, or in this case, value relative to growth. And you can see that has picked up after quite some time of falling against value falling against growth on a relative basis. So here we have the Shiller PE, which is for those taking notes at home. This is basically the cyclically adjusted price to earnings ratio. And so it just means it's being smoothed out a little bit, but you can see, we're basically very close to 20% right now. And you can see how that mirrors the annualized returns over the subsequent 10 years. And you can see, there is a very kind of an interesting, and I'd say modestly negative correlation, just meaning when your PE drops, you tend to have better returns that come off of those drops. So you buy the dips and you sell into strength, and you typically see this working in opposite directions. And interestingly enough, here you've seen a little bit more correlation lately, like they're moving in the same direction. But again, you've got the PE moving higher. We've got high valuations. The question is, what does that build in terms of expectations for future returns? And I think that's the argument that the article that I caught this in is trying to make. And it's just like in the future, we could have a rolling over of those annualized returns, because that's what history has kind of shown us. So I have a couple of slides here from Goldman that kind of give you some background on why I feel like we need to be eyes wide open in 2026. Here we have the average percentile rank since 1925 in market concentration, valuation, and magnitude of rally. You can see here, 2021, kind of a good point of reference here. The article here, and I believe this is to be true, is that the markets are, I think, overextended. And some parts of the market are clearly priced for perfection, which is very kind of almost troubling to have that roll off your tongue because of the implications for increased volatility ahead. And I think this is what this whole article is kind of pointing to. Is like, just don't be surprised if you see volatility pick up, because you've got these market concentration issues where where historically you can see that some of these rather stout downturns have occurred as a result of it. Now, no one's predicting a huge downturn again, barring a calamitous economic event. But if you have a little bit of breakdown in this hyperscaler earnings story, you've got increased competition for NVIDIA. You can certainly have something that feels a lot more like, at this level, which honestly, I'd almost argue that we're perhaps a little bit overdue for a 10% correction. Not that I want one, but I'm just saying, that we're being very cognizant of the stretchy aspects of valuation right now, and what that could do to volatility in the months ahead. So I took a particular interest in this slide right here. It shows you the All Country World Index. This is a stock index, basically global stock index. And you can see here the various country components and their weights. Now, if you introduced NVIDIA into this, and basically NVIDIA's representation within the U.S. component of ACWI, and again, U.S. Here represents about 60% of the ACWI index, and if you carved out NVIDIA by itself as a component of that 60%, it would be about 5% of the total ACWI index. So just to put this in perspective, that the weight of NVIDIA, one company, one U.S. company, is greater than the country weight of all of these other major countries that go into this stock index. So pretty profound when you talk about market concentration, and how certain stocks can greatly influence overall returns, and not just the S&P 500. So the last slide of the pack here today is something I found of particular interest, and it does have some economic ramifications, secular ramifications for commercial real estate. It used to be that, if you wanted goods, you wanted to do some shopping and personal spending, you would go to a department store. Well, you can see here from 1992 down to the end of this year, you can see that has just basically gone down to a trickle. And so people aren't going to department stores to buy things as nearly as much as they were. They're shopping online, which is what the red line represents here. And then to a lesser extent, you've got your Sam's Clubs and your Costco's and so on and so forth, which might be in slight decline. Again, because you have the opportunity, you go to these buying clubs to buy, in bulk, or to buy, maybe unique items at a discounted price. But again, you can still do more of that online. And so as we sit here, at this line before the pandemic, and it's like you look at the post-pandemic period, this is expanding at a pretty reasonable clip at the expense of the old brick and mortar. That's all we have for the chart pack today. Hope you have a wonderful week, and we'll talk to you again soon.